Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. It's Monday, January 12th, 2026. Let's dive into the most important residential and multifamily data from the last 2 weeks. All right, let's start with what's hot. And the big story, the one we've all been watching, is that national rent growth is finally turning positive. After a long 18 months of deceleration, national asking rents ticked up 0.3% month-over-month in December 2025. Year-over-year growth is now at 2.1%, which is actually the strongest reading we've seen since the second quarter of 2024. It seems clear that massive wave of new supply is finally being absorbed by the market. A very welcome sign. So where is this strength concentrated? You have to look at the Midwest. Markets like Indianapolis, Columbus, and Kansas City are the standout performers right now, posting impressive 4 to 5% year-over-year rent growth. The formula is straightforward. Limited new supply, strong local job growth, and a foundation of affordability that's driving demand. These markets really flew under the radar while everyone was focused on the Sunbelt pain. We're also seeing national occupancy stabilizing, which is another crucial indicator. It hit 94.2% in December, up a solid 30 basis points from its summer low point. The workhorse here is Class B, which is leading the pack at 95.1% occupancy. It really feels like the floor is in, and we're starting to build back from here. And when fundamentals improve, capital follows. Investor activity is definitely picking up. Transaction volume for multifamily assets rose 18% quarter-over-quarter in Q4 of 2025. We're seeing private equity and family offices leading the charge, and they're laser-focused on acquiring stabilized Class B assets in those strong secondary markets. Perhaps most importantly, those frustratingly wide bid-ask spreads are finally beginning to narrow. The market is finding its footing. Now, let's pivot to what's not. Because it's not a uniform recovery out there. First on the list, Sunbelt concessions are still elevated. If you look at markets like Austin, Phoenix, and Jacksonville, landlords are still regularly offering 6 to 8 weeks of free rent on new leases just to get heads in beds. This means effective rents remain about 3 to 5% below what's being advertised. The recovery is underway, but it's a slow grind. The core reason for that grind is that new supply is still being delivered. An incredible 440,000 units were delivered in 2025. That is the highest number since the 1980s. Now, the pipeline is shrinking, with another 380,000 expected in 2026. So the end is in sight, but the near-term pressure continues, especially in those oversupplied Sunbelt metros. And this supply pressure disproportionately affects the top of the market. National Class A vacancy is at 8.7%. Compare that to just 5.8% for Class B. The luxury product continues to underperform, as renters, even at higher income levels, are prioritizing affordability and value over brand-new amenities. Finally, we're seeing some softening in the single-family rental space, or SFR. Rent growth has decelerated all the way down to 1.2% year-over-year. That's a huge drop from 4% just a year ago. While elevated mortgage rates are keeping would-be homebuyers in the rental market, a surge of new build-to-rent supply is adding significant competition, putting a cap on rent growth. So, why does all this matter? The big picture is that the multifamily market is at an inflection point. After nearly 2 years of supply-driven pain, absorption is finally catching up to deliveries. But it is very much a tale of two markets. On one hand, you have the Midwest and many Southeast secondary markets that are looking quite healthy. On the other, the Sunbelt, particularly in the Class A segment, remains challenged. The data is clear. Investors who position themselves in workforce housing are now being rewarded, while those who chased luxury development in oversupplied markets are still working through a lot of concessions. This brings us to the investor takeaway. For now, the strategy should be to focus on Class B assets in supply-constrained markets. The Midwest secondary cities in particular seem to offer the best risk-adjusted returns right now. I would advise caution on new Class A deals in Austin, Phoenix, and Atlanta until those heavy concessions burn off, which now looks to be a story for mid to late 2026. That's your Monday multifamily update. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.